Hello everyone, my name is Wenjie Ge. I'm partner and portfolio manager from HSZ Group. We have recently conducted one-on-one meetings with our Swiss investors, and today I'd like to share our takeaways regarding Chinese equities. There are three key messages. First, the improvement of capital allocation and corporate governance. Second, the institutionalization trend of Chinese equities. And third, the revival of entrepreneurial China theme. Let me elaborate these three themes. First, on the capital allocation and corporate governance, we believe Chinese companies are increasing the dividend and also share buybacks. Their capital allocation policy is improving, and in 2024, we've seen Chinese companies bought back more shares than Japanese market for the first time. The private business owners are leading these buyback, and they believe their business is undervalued. Second, the institutionalizations of Chinese equity market. Compared with the developed market, where the equity market is typically dominated by the institutions such as pension funds, etc., in China, the market is heavily dominated by the retail investors. And as a result, the equity market tends to be more volatile, driven by the retail sentiment. However, in the last 2 years, we've seen regulators start to realizing the importance of institutionalizations of the domestic equity market. Starting in 2023, the regulator asked the pension fund, or so-called national team, start buying equities. In early 2025, we've seen regulator requesting the state-owned enterprise insurance company to raise their domestic equity allocation from 12% to 30%. This is actually mimicking Japan's success in the last decades. In 2013, Japanese regulators requested GPIF to increase its domestic equity allocation from 13% to today's 26%. This was the beginning of Japan's equity rally in the last 10 years. Third, the revival of entrepreneurial China theme. In February 2025, President Xi met a group of private business leaders, including Jack Ma from Alibaba. We believe his key message to the private business owners is that he would like to see more investment by the private companies and to help the country to generate more jobs. Not surprisingly, 2 weeks after that meeting, Alibaba announced its results, and during the results, they announced for the next 3 years, their capex is going to be equivalent to the last 10 years of its capex. We've seen some success of Chinese entrepreneurial companies in the hardware industry, such as BYD in the car industry, leveraging China's fast growth EV market. We've also seen the success of Chinese software companies, starting from 3 years ago of TikTok, Shein, Temu, and this year's DeepSeek. In fact, more than 60% of the global AI is now actually invented in China. And in 2023, the citations of Chinese engineered AI patents have actually exceeded the US for the first time. We believe China is moving quickly in the technology curve, and humanoid robot is going to be the next big theme in China. Driven by the improved capital allocation, corporate governance, the institutionalization of the equity market, and revival of entrepreneurial China theme, we believe the market could further re-rate from today's low multiple. Our entrepreneurial China fund is trading at 26 times PE, which is 2 standard deviations below the long-term average, with a 24% EPS growth and 22% ROE. China is well positioned in the Trump 2.0 era, and the property crisis is largely behind us. The household balance sheet is strong, and we are positive on China. Thank you.